Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. You've sent over a really compelling set of articles today, drawing from all the major financial publications. What immediately jumps out is just the sheer breadth of the reaction to these newly announced tariffs. We're seeing impacts across stock markets, specific industries, currencies, even gold and crypto. It's a truly interconnected web of responses.
It really is. And, diving into these headlines, what's fascinating isn't just the immediate negative reaction, which was, well, pretty stark, but also some of the more nuanced and maybe even counterintuitive effects that are starting to bubble up. It just highlights how incredibly complex global trade and financial markets have become.
Okay, let's definitely unpack this because the central event dominating, well, pretty much all these front pages is, without a doubt, President Trump's announcement on Wednesday, April 2nd, of these sweeping new tariffs. From the tone of the reporting, it sounds like the market was really caught off guard by the severity.
That's certainly the sentiment coming through, yeah. MarketWatch and CNBC both prominently featured that quote from Wedbush's Daniel Ives, who called these tariffs worse than the worst-case scenario.
Yeah.
That kind of assessment, especially from a well-regarded analyst like Ives, it really sets the stage for understanding the market's anxiety.
Absolutely. And when you look at the specifics, like as detailed by MarketWatch and CNBC, you can see why there's so much concern. A 10% baseline tariff across the board, that's significant already. But then you see these jumps, 34% on China, 20% on the EU, 32% on Taiwan, and wow, 46% on Vietnam. These aren't just little tweaks, they're substantial levies that are, bound to affect the cost of goods.
Precisely. And as both Bloomberg and MarketWatch reported, the immediate response in the futures markets was dramatic. We saw significant drops right across the board. Dow futures, S&P 500, NASDAQ futures all took a major hit. In fact, Bloomberg and MarketWatch both noted S&P 500 futures were down over 3%. And CNBC reported NASDAQ 100 futures plunging even further by more than 4%. That gives you a real sense of the speed and the intensity of the market's reaction. Investors were clearly spooked.
Yeah, you can say that again. And it wasn't just the broad market indicators, was it? MarketWatch specifically highlighted the sharp fall in Apple stock, like 7.1% down in after-hours trading. They pointed out that if this holds up in regular trading, it'd be Apple's worst single day since September 2020. That's clearly tied to worries about their, huge supply chain over in China.
Right. I mean, given Apple's reliance on manufacturing in China, these tariffs pose a direct threat to their cost structure and potentially their ability to deliver products at current prices. And as CNBC reported, this concern just rippled through the whole tech sector. The thinking is these tariffs could lead to both demand destruction if prices go up and significant disruptions to those incredibly complex global supply chains that tech relies on. They specifically mentioned other giants like Amazon, Tesla, Alphabet also feeling the pressure. It really underscores just how interconnected the tech world is globally.
It really does. It's like a domino effect. And the unease wasn't just in stocks, right? Bloomberg's reporting showed a broader move away from riskier assets, including Bitcoin and other cryptocurrencies. Bitcoin, for instance, fell like 4%, down around $82,000, and Solana took an even bigger hit, dropping over 9% at one point. Suggests investors were looking for safer places pretty much everywhere.
Exactly. When you get this level of uncertainty in the traditional markets, it often spills over into other assets seen as higher risk. And speaking of seeking safety, Bloomberg and MarketWatch both highlighted a really notable decline in the US dollar. Now, this is interesting because sometimes you'd expect tariffs to actually strengthen a country's currency.
Right.
MarketWatch even noted it was on track for its steepest drop in, 2.5 years. This might suggest the market's actually anticipating broader economic disruption from these tariffs, maybe weakening confidence in the dollar itself.
That's a key point. So, while the sort of textbook theory might be tariffs make domestic goods more attractive, strengthening the currency, the market seems to be pricing in a different, maybe messier scenario here.
Mm-hmm.
And at the same time, as Bloomberg reported, we saw that rally in traditional safe havens like gold, which hit a new record high.
Mm-hmm.
And we also saw Treasury yields falling, which both Bloomberg and MarketWatch noted. So for listeners, when investors get worried, they often pile into safe U.S. Treasury bonds. That pushes bond prices up, and yields move the opposite way. So yields go down, classic flight to safety signal.
Precisely. It's a clear sign of risk aversion really taking hold. And this wasn't just a U.S. thing either. Both Bloomberg and MarketWatch documented how this negative vibe spread globally. European and Asian stock markets felt it too. The Stoxx 600 apparently slipped 1.5%, and Tokyo's Nikkei lost almost 3%. It paints a picture of a sort of synchronized global equity sell-off.
And the ripples went beyond financial assets too, didn't they?
Mm.
Bloomberg also mentioned pressure on commodities like Brent crude, copper, aluminum, zinc. That suggests a worry that these tariffs could slow down global economic activity, hitting demand for raw materials. So, yeah, across the board, the initial market reaction was significant and overwhelmingly negative.
Absolutely. It's like the market's collectively just holding its breath, waiting to see what the actual longer-term fallout from these tariffs will be.
Okay, so we've got the broad market picture. Now let's zoom in a bit on specific sectors and companies. We touched on tech with Apple, but what other industries are really feeling the heat based on these headlines?
Sticking with tech for just a second more, CNBC and that report you mentioned on U.S. stocks with high China revenue exposure, they really underscore the challenge for chip makers like NVIDIA. With, what was it, 39% of their revenue tied to Greater China, including Taiwan? They face considerable risks. We're talking potential pricing pressures, disruptions to that incredibly complex semiconductor supply chain, and maybe reduced demand from Chinese customers if things escalate.
Right, the chip industry is so globally tangled that tariffs like these can just throw a huge wrench in the works. Okay, what about autos? There were some interesting reports there.
Yes, Bloomberg reported on Volvo's immediate and pretty direct response. Their CEO announced plans to boost U.S. production specifically because of these new tariffs on imported cars. It's worth remembering, as the article noted, there's already a 25% tariff on U.S. auto imports, so this adds another layer. It'll be interesting to see if others follow suit and what the practicalities of shifting production quickly actually look like.
And then there was that odd Tesla situation. MarketWatch noted their stock initially popped a bit on speculation Musk would refocus on the car maker.
Yeah, a little blip.
But that didn't last long, apparently. Tesla futures then sank with everything else once the full tariff impact became clearer. Seems like even potential company-specific good news couldn't fight the overall market gloom.
Exactly. The overarching economic uncertainty just seems to be the dominant factor here, overshadowing potential short-term company wins. Now, shifting gears a bit, let's talk about a sector maybe not top of mind with tariffs: Bitcoin mining. Bloomberg had a really fascinating piece on how these levies could seriously disrupt their supply chain.
Oh, right. Because the hardware, the actual mining rigs, they're mostly made in Asia, aren't they?
Precisely. The Bloomberg article highlighted this scramble, mentioning Luxor Technologies' Lauren Lin rushing to ship a bunch of mining machines from Thailand before the tariffs hit. The article specifically called out the really steep tariffs on Thailand, 36%, and Malaysia, 24%, taking effect April 9th. That rush really shows the immediate financial pressure these miners are under.
And the market saw that too. Bloomberg reported shares of U.S.-listed miners like MARA and CleanSpark just plummeting.
Yeah, the expectation is these tariffs will significantly hike their capital expenditure, making it way more expensive to buy and deploy new mining gear. That hits their profitability directly and their growth prospects in what's already a super competitive industry.
It's like a double whammy, right? Higher costs up front before they even start earning under the new rules. Now, another interesting angle was the hedge fund activity. Bloomberg reported a record pace of hedge funds dumping global stocks back in March, seemingly anticipating this.
That's a very telling data point, isn't it? The fact that these, sophisticated investors were already significantly de-risking suggests the potential fallout from these trade policies was a major worry even then. Bloomberg noted North America saw the biggest regional outflows, and tech stocks had the biggest net selling in the U.S., which fits perfectly with the market reactions we've been talking about. It kind of suggests that they saw the writing on the wall.
Sounds like they were trying to get ahead of the curve. We also saw that Goldman Sachs analysis, highlighted by CNBC, pointing out companies with major revenue exposure in Greater China. Some interesting names there.
Indeed. They specifically mentioned casino operators with a big footprint in Macau, like Las Vegas Sands and Wynn Resorts. According to that report you shared, LVS gets something like 63% of its revenue from Greater China, and Wynn's at 47%. It just highlights how sectors relying heavily on Chinese consumer spending could be really vulnerable if these tariffs spark retaliation or, slow down the Chinese economy.
Right, because discretionary spending, travel, entertainment, that's often the first thing people cut back on when things get uncertain. And then Bloomberg also mentioned apparel and footwear companies took a significant hit too.
Yeah, companies like Nike and Deckers, they make Uggs. Their stocks apparently slid around 11%, according to Bloomberg. That's likely a direct result of those hefty tariffs on Vietnam and other key manufacturing hubs for clothes and shoes. It just pushes their costs up.
So we're seeing a pretty wide range of sectors feeling the impact: tech, autos, mining, casinos, consumer goods. But were there any like unexpected or surprising reactions that stood out in the reporting?
There were a couple of really interesting ones, actually. Bloomberg reported on the sudden stop to that previously strong arbitrage trade shipping gold and silver to the U.S. Because precious metals were kind of surprisingly exempt from these new tariffs, the U.S. premiums that made that trade profitable just vanished. So premiums tumbled and U.S. inventories surged. It's a fascinating example of how an exemption can just totally disrupt a specific market activity.
Huh. That's a really subtle effect. You wouldn't immediately think tariff announcement impacts gold arbitrage? Okay. And then there was the dollar again. We touched on it. But MarketWatch dug into why it weakened, which kind of goes against some traditional economic ideas, right?
Right. While sometimes tariffs are expected to boost the currency and make domestic goods look better, the market seems to be reading these particular tariffs as a potential drag on overall U.S. growth. MarketWatch highlighted Sajin actually recommending investors buy shares of companies with big international exposure to benefit from this weaker dollar. They mentioned names like Morgan Stanley, Microsoft, Meta, Alphabet.
Yeah.
The logic being, a weaker dollar makes their overseas earnings worth more when converted back to dollars. So it acts like a sort of hedge against domestic slowdown worries.
So a weaker dollar, while maybe adding to inflation later, could actually help the bottom lines of big multinationals right now.
Yeah.
That's a really interesting dynamic. Any other unexpected ripples?
Yeah, China's reported plans via Bloomberg to diversify its offshore bond program caught my eye. Even with these trade tensions ramping up, they just did a successful green bond issue in London and are signaling they want to engage more with global investors, regular bond sales, different currencies, international markets. It suggests a longer-term strategic view that maybe looks beyond the immediate trade spats. Like they're saying, yeah, trade's tense, but we're still playing in the global financial system.
It's a subtle signal, maybe, but potentially significant about their long-term game. Now, that Bloomberg piece on the Cayman Islands reinsurance hub seemed a bit off to the side at first. How did that fit in?
Well, it's not directly caused by these tariffs, but it does show how global financial activity shifts based on different regulatory scenes, right? The Caymans, with their more flexible capital rules compared to, say, Bermuda, are attracting U.S. insurance execs. But then you have companies like Apollo raising concerns about the potential risks of that looser regulation. It's just another example of how these financial landscapes are always shifting based on policy differences.
It just underscores how interconnected everything is and how policy changes here can have weird knock-on effects over there.
Yeah.
Now, we even saw a piece from the Wall Street Journal about CD rates. How on earth does that fit in with global tariffs?
Yeah, on the surface, it seems totally unrelated. But the WSJ article pointed out research showing longer-term CDs often pay more than shorter ones, even if you factor in early withdrawal penalties. They called it internal inconsistencies in bank pricing. So in the context of all this economic uncertainty we're talking about, driven by tariffs, market volatility, it actually offers a practical, maybe valuable insight for our listeners on personal savings. It's a reminder that even amidst these huge global shifts, there are sometimes smart individual financial moves to consider to, try and maximize returns or navigate the uncertainty.
That's a great point. A bit of actionable info amidst all the macro chaos. Okay, so we've covered the initial reactions, the sector impacts, some surprising side effects. What are the experts saying overall? What's the outlook?
Well, going back to Daniel Ives at Wedbush, despite that initial harsh assessment, he does think, according to MarketWatch and CNBC, that Apple will probably manage to get tariff exemptions, similar to how things went last time around. So there's still a chance some of this could be dialed back or targeted differently.
Right, which fits with that idea that maybe these are just a negotiation tactic, as Adam Hetz from Janus Henderson suggested in MarketWatch, that these super aggressive tariffs might just be the opening bid, not the final word.
Exactly. But the more widespread concerns voiced by various strategists in Bloomberg and MarketWatch really center on the potential for a slowdown in global trade and overall economic growth. There are also growing worries about stagflation, that nasty mix of slow growth and rising inflation, and just a higher risk of recession generally. These are pretty significant concerns floating around.
And it seems almost inevitable we'll see retaliation from China and the EU, right? Both Bloomberg and MarketWatch mentioned that. That could definitely escalate things further.
Absolutely. And finally, there's just no consensus among strategists, as Bloomberg noted, on whether this big sell-off is a buy-the-dip moment. Some think it's overdone and markets will bounce back. Others are advising a lot more caution given all the uncertainty around trade and economic policy.
So basically a whole lot of uncertainty, high potential for more volatility, and a real sense that the global economic setup has been significantly shaken up by these tariffs.
Precisely. These headlines, you put them all together, they paint a picture of a market really grappling with a major policy shift, trying to figure out the ramifications across every sector, every asset class. While there are some, unexpected dynamics and maybe some mitigating factors, the overall feeling is definitely one of concern about where global trade and economic growth are headed.
And that's exactly what we aim for with this deep dive, to cut through the noise of the headlines and give you, our listener, a clearer, more complete picture of today's major financial events. We've looked at the big market waves, the impacts hitting different sectors, some of those surprising twists, and just the general uncertainty that's hanging in the air.
Yeah, we hope this discussion has given you a solid base for understanding these complex events and maybe some useful context for interpreting the different expert views out there. It's definitely a situation that's going to keep evolving fast.
For sure. So as you digest all this, we'd encourage you to think about the various perspectives we covered and how these shifts might play into your own investment plans or business decisions.
And maybe a final thought to chew on. Given how deeply interconnected our global economy really is, how might these seemingly specific policy decisions like these tariffs end up unleashing a whole cascade of far-reaching, maybe unintended consequences that we're only just starting to see?
We'll see you all tomorrow morning with new headlines from major financial magazines.